Alright, so let's start. Name of the reading is Understanding Income Statement. It's a long reading. There are a lot of small nitty-gritties that we will have to remember. Plus there are also a couple of types of calculation that we'll have to get ourselves through with. So first 20 minutes we will spend on just building a perspective about what is the use of income statement, and we'll look at a few income statements of the companies. So what I have here is income statement or 10K of Coca-Cola. So we're going to just open the income statement and build some sort of perspective here. Do you see consolidated financial statements anywhere? Okay, so consolidated statement of income is what we are looking at. So is this visible? So what we have now, the data is in $1 million net operating revenues, right? So the idea of income statement is we want to see the performance of a company in a particular year. So you can think of this as similar to report card, that we used to get in a school, which will tell us how we performed during the year. So we start with net operating revenues. So operating means business related, revenue in a way think of this as sales. So what is the total amount of sales that Coca-Cola has been able to generate? We have 2015 data here. Financial year ends on December 31. So that's 44294. Then minus COGS, cost of goods sold. And cost of goods sold is essentially the manufacturing cost, right? So it will include the cost of raw material, cost of labor, processing cost, everything with respect to manufacturing. So you reduce cost of goods sold, and what you get is the gross profit, which is 26812. Then we reduce S, G and A expenses, selling, general and administrative expenses. So all operating expenses which is not COGS and not depreciation, we typically put in here. Okay, so that amount is 16427. Other operating charges, and then we have operating income. We can also call this number as EBIT. Then reduce interest expense income, and you get income before taxes, charge taxes, and you have net income, right? That's how we should be looking at income statement. So the first thing we'll do today is get ourselves acquainted with the format. So let's write down the format here. So starting point for any organization would be sales. At times we use an alternate word, revenue. So we will say sales less COGS, sales less COGS, and that would give us gross profit. Okay, so profit that you've generated from your manufacturing activity. Then gross profit less S, G and A. SG and A stands for selling, general and administrative expenses. So gross profit minus the SG and A, that would give us a number called, now slightly changing the structure here. So this would give us a number called EBITDA. EBITDA stands for earnings before interest, tax, depreciation and amortization. Then less, tell me, depreciation or amortization. So depreciation or amortization, and then we are left with EBIT. Then we will say less interest expense. If there is an interest income, we will add below this, and it gives us EBT less taxes, and we have earning after taxes or profit after taxes or net income. Are we okay with this? Now this EBIT is called as the operating profit. EBIT is called as the operating profit. EBITDA is called as cash operating profit. So this is your cash operating profit. Now, since EBIT is your operating profit, that means everything that's above the EBIT on your income statement, that is the operating part. That's the operating part. And the stuff that we have below that, we typically call this as non-operating part. So most importantly, interest is considered as a non-operating expenditure. Okay, so COGS is a operating expenditure. Why? Because it is with respect to your manufacturing. So manufacturing expenditure. Then SG&A is operating expenditure. What does it include? It includes, let us say, sales cost, distribution cost, advertisement cost, salary paid to the employee. So all other business related expenditure goes into SG&A. Then depreciation and amortization. Is this operating? Depreciation. Is it an operating cost? So it's an operating expenditure, but it is non-cash. Operating expenditure, but it is a non-cash expenditure. And typically interest, we will call this as non-operating expenditure. Are we okay with this? So based on the data that we have now on Coca-Cola, we can do certain interesting ratios. The first thing that we can do is we can calculate something called as, and we will do this for 2015. So we can calculate something called as GP margin. GP margin would be gross profit margin. So we will say that total revenue of the organization is 44294 and the cost of goods sold is 17,000, which means your gross profit 26,812. So how much is gross profit as a ratio to total revenue? And that number would be gross profit as a ratio to total revenue. That number would be 60.5%. So which means on an average, if GP margin is 60.5%, that means on an average, the manufacturing cost of the product is about 39.5%. Is that making sense? Then we can also calculate an operating profit margin. So operating profit margin would be, what is your EBIT? How much is your EBIT here? Look at this. How much is your EBIT? 8728. So 8728 as a ratio to 44294. That means I am taking it as a ratio to sales. Operating profit divided by sales. And how much would that be? Sorry? 19.7%. Then again we can do a net profit margin. So net profit margin is, your net income is 7366 as a ratio to 44294, and that would be 16.6%. Are we okay with this? Now how do we make use of these ratios? So we can either do a cross-sectional analysis or we can do a time series analysis. Okay, so we are still learning and we are building perspective, but if we had to analyze a little deeper, we could have done either of the two analysis. Cross-sectional would have been comparing with peers, right, with competitors, so figure out what are their profitability vis-a-vis ours, and if our numbers are better, then of course it's a good sign. What would be a time series analysis? Comparing with our own ratios for the last few years. Correct? So how has been my gross profit margin for the last 6, 7, 8 years, and that will give you trends on how the manufacturing cost and sales price is moving. Are we okay with this? So let's go and see if we can, or answer the first learning outcome. Okay. So components of income statement and alternative presentation formats. So what does income statement have? Revenues, expenses and gains and losses during a reporting period. When you prepare a balance sheet, is it for the period or at a particular date? At a particular date. So that's the difference between the two. Balance sheet is a point estimate, as in it is only for that particular point of time, whereas an income statement you prepare for the entire accounting period. Okay, now this is interesting. You can classify the cost. You can classify the cost either based on function or based on nature. Classification of cost either based on function or based on nature. Right, so look at the different costs on your income statement and then see that whether those costs could be classified, whether those class can be classified as cost for a specific function or cost for which cannot be assigned to a specific function. For example, COGS. Now can we say that COGS can be specifically assigned for manufacturing activity? So we will say COGS. In the same fashion, let us say SG&A. Now again, it is a function in the business, selling or general or administrative. So SG&A gets classified here. But think of interest. Okay, so interest cannot be a function and therefore we typically would classify interest as nature. Are we okay with this? So that's how costs could either be classified based on the function or they could be classified into function or nature. Then net income of an organization is revenues minus ordinary expenses plus other income. Other income is commissions. So income may be through non-operating sources. For example, let us say during the year you sold your land and you made some amount of profit on that. So then we would classify that as into other income. Other expenses and gains and losses again through sale of properties or sale of investments, and that's how you get the total net income. The question that's been asked, profit from sale of land, where should that come in the income statement? So the first question you ask yourself, that is this operating income or is it a non-operating income? Okay, that means is it in the nature of something that I do on a very regular basis or it's a one-off event? If it is one-off event, then the best practice would be to put it after EBIT, right? So you would say EBIT plus profit from sale of whatever assets, and then you will get minus interest and then EBT, right? But a lot of companies at times also club that after revenue at the top of the income statement. So as an analyst, you have to make certain adjustments to sanitize those income statements. Alright guys, next concept, non-controlling interest. Okay, now this is a little interesting. I'm going to spend some time on this. So give heading in your notes. Non-controlling interest. Non-controlling interest. At times, we also call this as minority interest. Okay, so try to build perspective on this now. Okay, I'm just trying to simplify a little here. So we have a large company here, and on the left hand side I'm going to write equity and liabilities, on the right hand side assets. Okay, this large company has two main shareholders, so let's call them as A and B. So I'm writing them on the equity section. Now this is a smaller company, and a smaller company also has two shareholders. Let's call them as C and D. Okay, now C has 70% ownership and D has 30% ownership. Now what happens is that this company, the large company, has acquired all the shares of C. That means this company now has acquired 70% stake in a smaller company. So once you've acquired 70% stake in a smaller company, after that we prepare something called as a consolidated balance sheet. A consolidated balance sheet is where you include numbers of both the organizations. So your consolidated balance sheet would be like this. Whatever assets that this firm had, okay, and your assets. So let me create some hypothetical scenario. If this firm had an asset of 100, okay, whatever assets, so assets of 100, and this firm had assets of, let us say, 500. So when we prepare consolidated balance sheet, we will say assets 500 plus 100. Are you following this? In the same fashion, if this firm had a liability of, let us say, 100, and this firm has a liability of, let us say, 300. Okay. So when we prepare consolidated balance sheet, we will say liability of 300 plus 100. We are just going to add up the balance sheets horizontally, everything that's there on the balance sheet, but we don't add up the equity because the number of shares might have not increased. Are you following this? So the way it works is, now we will say that there are 3 owners of this entity. Who are the 3 owners of this entity? A is still a owner, B is still a owner, and now we also have a small owner who has a very small claim in the combined entity, and he would be D. So this D on the consolidated balance sheet is referred to as the minority interest. Now what it simply means is, we start thinking of that shareholder of your subsidiary that are not you. Shareholder of your subsidiary, we start thinking of him as our own shareholder. Are you following this? And then these guys do come on the minority interest section, and minority interest is nothing but a part of equity. Are you okay with this? Do you want to ask any questions here? Okay. So I'm going to लिख लिया आपने, लिखना है? I'll send you the PDF. So I'm going to show you some numbers here so that you will get an opportunity to build perspective. So let us say this is a balance sheet. On balance sheet we have equity of, let us say, 1000, liability of 300, PPE of 900, and cash of 400. This is subsidiaries balance sheet. They have equity of 500, liability of 100, and PPE of entire 600. Now what this firm has done is, this firm has acquired, let us say, 70% stake of this company at a price of 350. I'm intentionally matching the numbers, otherwise it creates a goodwill. Okay, so the amount that we're paying is exactly proportionate so that we don't have to have goodwill in this question. Now once this is done, this is how your consolidated balance sheet is. Okay, so your consolidated balance sheet, and let me do that here. Consolidated balance sheet. Now that balance sheet would be like this. Equity, let me come on to it later on. Liability 300 plus 100, 400. PPE 900 plus 600, 1500. And cash 400 minus 50, 350. Why are we saying, so sorry, 400 minus 350, 50. Why are we saying minus 350? Because 350 is the cash paid to the shareholders of the subsidiary company. Are you following this? So your minority interest, which is going to be a part of equity. So your equity doesn't change, your equity remains same, 1000. Minority interest would be what portion of my subsidiary I do not own, and portion of my subsidiary that I do not have is 30%. And the valuation of subsidiary was 500, so minority interest should be 150. So therefore your balance sheet total on both the side is going to be 1650, 1550, balance sheet total 1550 and 1550. Right? That's how we make the balance sheet tally at time 0. Okay, now observe carefully. Now, assuming that you're comfortable with this, so we're going to assume this as time 0. Okay, so balance sheet time 0, and this balance sheet is referred to as standalone. Standalone means not including subsidiary, and this is your subsidiary financials. Okay. Now what happens is, in the next period, these are your income statements. So this is your income statement. Your sales is 1000 and your cost is 500 and your profit is 500. Okay, this is your standalone income statement. Now this is your subsidiaries income statement. So subsidiaries income statement, their sales let us say is 200, their cost is 100 and their profit is 100. Now you prepare a consolidated income statement. Okay, so consolidated income statement works out like this. Consolidated income statement. Here you would say sales 1000 plus 200, 1200. Cost 500 plus 100, 600. So total profit before minority interest. Total profit before minority interest 600. But the question is, do we have claim on that entire profit of 100? No. So we will say less the share of minority interest, and minority interest share is 30, and therefore the net profit available for equity shareholders is 570. Now what happens with this profit? So this is your consolidated balance sheet. Okay, consolidated balance sheet from time 0. I'm just going to copy paste what we had on the previous balance sheet. So we had equity of 1000, we have minority interest of 150, then we have liabilities of 400, PPE was how much? 1500, and cash of 50. Okay, now make sure you understand this well. If your sales is 1200 and if your cost is 600, can I say, assuming everything is in cash in a very simple structure, your cash should increase by 600? If you made sales of 1200, cash will increase by 1200. Cost of 600, cash will decrease by 600. So effectively, net effect is your cash will increase by 600. So this is my first effect. Okay, plus 600. Now, on the asset side, I have added 600. Now what we do is, this 30, we add up to the minority interest section. And this 570, we add up to the equity section, because that 570 is profit of our shareholder and 30 is the profit of minority. So we will add a 570 here and 30 here, and that's how your balance sheet tallies. And now this becomes a balance sheet at time 1. Have you understood this? So every year what we do is, when we prepare consolidated financial statements, we add up the two income statement. But then at the bottom, we divide the profit into two parts. How much of the profit is minority interest and how much of the profit belongs to equity shareholder. Then minority interest part we transfer to minority interest, and our profit we transfer to equity section in retained earnings. That's how we keep on doing it on a year-on-year basis. Are we okay? So what you need to know for the exams, you need to know what is the balance sheet treatment of minority interest. Okay, so minority interest is a part of equity. Who are minority interest? That part of the subsidiary that we do not own. Then second thing you need to know is what is the income statement impact. So whatever is the profit, net profit, that profit we break down into two parts. The part that is minority interest and part that is ours. Our minority, the minority interest goes to this section and our profit goes to this section. If you know this, you're covered. Are we okay? Do you have any questions here? Alright. So again, one important sentence is, as per both IFRS and US GAAP, as per both IFRS and US GAAP, minority interest is to be treated as a part of equity. So this is something you specifically would want to remember for your level 1 exam.